This video tutorial will look at costs and revenue. So to start off, let's think about two key terms that are important in business when we think about the movement of money and defining revenue and costs, and those are cost and price. And the price is what a business offers a product or sale at to its customers. So customers will give the business some money, so there's money coming in, paying the price to take the goods. In exchange, the business obviously gives the goods, but obviously it had to get them from somewhere. So they have to pay their suppliers, and money leaving a business to pay for items is referred to as a cost. So money coming into a business from sale of products or services is price, money leaving is cost. So what sort of costs might a business have? Well, many. Stock. So the more the business sells, we have to pay for the stock that we're purchasing from our suppliers. We'll have to pay for rent of premises, maybe shops or factories, and we'll probably have to pay for the salaries and the wages of our employees. Another cost we might have to think about is maybe things such as electricity, gas, water, and maybe phone bills. All of these are different types of costs in the business. Let's have a look at them one by one. So our first costs are called fixed costs. So our salary we're paying to our shop worker, the rent for the building, even things such as advertising machinery are what are called fixed costs. Now, a key definition is that fixed costs do not vary in relation to output. If our worker is working and sells one good in the course of a day, we'll still pay him the same salary as if he'd actually sold 100 items. The same with the rent. If we're advertising, we could get lots of response, we might get no response. We'll still pay the same for it, and the same for our machinery. These costs do not change in relation to output. Even if the shop's closed, we still have to pay for our rent, for example. When our worker is taking holiday and not producing anything, part of his contract, he will still be paid his salary. So these costs do not change when the business is producing zero. If we produce one more item or sell one more item, or we sell one less, these do not change. They are fixed costs, they do not change in relation to output. And that change in relation to output is something that many students forget to mention. They can vary, of course. Rents do go up, and employees do get pay rises, but the key thing is not in relation to output at this level, certainly not in the short term. Another type of cost is a variable costs. Now, variable costs do vary in relation to output. So here's our stock as a classic example. The more that we sell, the more that we'll have to purchase from our suppliers. So the costs of stock will increase. Equally, packaging for our stock. Once we sell it to customers in bags, boxes, maybe even posting it to them, that's going to cost us more the more that we sell. Some employees may receive piece rate, so they get paid on each item they produce. So the more they produce, the more that they will actually earn. Again, we might not actually pay these if we produce nothing. If a business is closed, we won't sell stock, so we won't incur any cost in replacing it. Again, if our employees are only on piece rate, or only on what they produce, if they produce nothing, they'll earn nothing. Selling one more item will increase our total variable costs by the amount of that item. Which brings us to our semi-variable costs. Now, semi-variable costs are the third and final type of cost. Total cost, by the way, is adding all three of these types of costs together. So, what makes a semi-variable cost? Well, actually, it's a very interesting cost that has features of both fixed and variable. It does change with output, but at the same time it doesn't. Well, how does this work? Let's think about a mobile phone. A mobile phone on contract has a certain payment that's paid each month, for example, for the use of that phone. This is often known as line rental. You may pay the same for your internet access at home. So there's a set amount. If you don't use the phone, you don't use the internet, you still have to pay this amount. So this is the fixed element of that service. You may have included in it free usage. So mobile phones, you might get free data usage. You might find that you also get free minutes or free texts. So this is the fixed element. If you don't go beyond this, the price will be predictable and stay the same. However, if you go over these levels, you'll pay extra for them. So the more you produce, the more you use your phone, in this example, the more you'll pay. So again, moving over that basic allowance will increase the charges. So for a business, utilities are an example of a semi-variable cost. Electricity boards will actually charge companies for a certain connection, and then they'll pay them for the amount they use. There's a fixed element and a variable. Equally, salaried staff may earn a certain amount, which is fixed per year, but they may earn bonuses linked to sales. So if they sell a certain amount, they may get an increased payment. So again, this makes it semi-variable. Remember, add semi-variable, variable and fixed together, and you end up with total costs. Well, that's great. That's money leaving a business. Don't really like this. Let's think about the flip side. Well, the flip side is revenue. Revenue is the money that business receives from sales or turnover. So alternative words, they mean exactly the same thing. Revenue is the money coming into a business. We calculate it very easily by multiplying the price that we charge a customer, say £1 per item, by the number of items we actually sell. So in this example, the more items that the business sells, the more money it receives from revenue. The way I like to think about it is cash going into the till for the business. So it's the money paid into the business from its sales. The more sales we make, the more money goes into that till. Remember, this is just the money coming in. Our costs are the money going back out. Our fixed costs don't change with output. Our variable costs that do change with output. Our semi-variable costs that have elements that do and don't change with output. So hopefully you're feeling a little bit clearer now with costs and revenue.